Okay, now the next on the agenda is moneyness. Now, we briefly touched this topic, but I want to take you through some examples on the platform to show you how does it affect the option prices and how does it affect our decision making process when we are trying to sell these options. Now, let's stick to the same one. Apple, fine. Moneyness. So at the money line is right above here. The stock is trading at the money is where the stock is currently trading, or somewhere around it, very very close to it. So it's trading at 225. The next strike available is 225.5. So that's at the money. This one is at the money. Fine. The at the money call side. Now, first look at the from at the money to in the money, and then we go out of the money. From at the money to in the money is this way for calls. You will see the debit that you will keep on paying. Look at the ask column. The further in the money you go, more debit you will pay because now the stock has um, a less of a hurdle because the stock is already in the money. Now, when you say in the money, meaning the stock price is already above these strike prices, so you're paying a hefty debit for it. You're paying a bigger price for it to get um, in these options contracts. Now, you can see that this goes, the strike changes are $2.50 all the way through, well, up to at least here, and then you go into $5 increments here. But the change in the option price is slightly different. $2 here, around $2 there. Well, roughly, I would say $2 to $3 to $4. The further in the money you go, the bigger that change is. Look at this one here. It's almost $5, right? $5, 4.50, whatever. So that's how you look at the in the money call series on all these strikes. Now these are the strike prices. Right? Now let's look at the out of the money options on the call side. So now your call needs to go through a hurdle. It hasn't really crossed that mark yet, but it needs to go through that hurdle. So the further out of the money you go, the cheaper the option is. Look, if you were to buy this option, the cheaper the option is. The reason for that is the stock has to go over a bigger hurdle to get to this point. So let's say if your strike price is 245, it needs to go from 225 to 245. So $20 on top here in order to get in the money. And therefore it's a bigger hurdle to cross. So therefore this price is cheaper. So you can take this bet at a lower price. But the probability of that happening is only 6%. Look, it's 5.09. I can tell that by the deltas. So the further in the money you go, the higher the deltas you will get. On the positive side, it always goes from 0 to 1. For calls, look at the delta series here. Now 1 is basically in the money, like completely in the money. These are 100 deltas. And anything down here is completely out of the money. So that's the call side on the left here to buy the call options. Now, if you were to buy a 30 delta call, you have this. What this is showing you is that you have a 30% chance of making any money on this contract. 30% chance, and you can tell that by this probability of being in the money, which is around 27.48. Fine. Let's look at the call, put side quick. This is the let's look at the in the money side first. From at the money, which is here. This is at the money. A D. I cannot type. This is too difficult. This is at the money here, 225. Now you're going from at the money to in the money. So basically, the stock has already gone past this hurdle, and therefore these options have now become very, very expensive. And therefore you're paying a higher price for it. That's the ask side. This is what the ask side is showing. Look at the increments here, $2.50, $2.50, but then once you go past 250, only $5 increments are available. And now out of the money. Now the stock has to go below its current price for you to make money if you were to buy this spot option. So therefore these options are cheaper. Now look at the prices here. These are cheaper options because the stock has to go over a bigger hurdle. From 225 down to 210, it needs to drop by $15 within 22 days or 23 days for it to become in the money. and therefore these options are cheaper. So the further out you go, the cheaper the options are. Just remember that. The further in the money you go, the more expensive these options are. And that's what moneyness is. At the money line is this. The next is extrinsic value and intrinsic value of these options, which we will discuss later. You don't need to know that right now. I just want you to be familiar with all these basic jargons here so you can go out and put a long call or a long put position on by yourself. In a paper trading account, not not in a live account, but in a paper trading account, you should be able to go there, read the chains, set up your platform, and be able to put a position on and take it off. Doesn't matter if you make money or not, just keep practicing. Once you've done 20, 25, 30 of those, then let's come back and discuss the intermediate section or the intermediate playlist that I will be creating soon. That's when we can actually do these strategies. Thank you, and I'll see you in the next one.